Something fundamental has shifted in the silver market. And if you're watching this, you've likely noticed it too. Silver has broken through resistance levels that held for years. This isn't just another spike. This is a structural move that signals a change in how global capital is positioning itself. For those who've been holding silver, this moment feels like validation. For those who haven't, this moment feels like uncertainty. Both responses are understandable. But what matters now is not how you feel about what's happening. What matters is understanding what's actually happening. Because the truth is this: most people will misinterpret what they're seeing. They'll either dismiss it as temporary noise or chase it with blind enthusiasm. Both approaches ignore the deeper forces at work. This video is for those who want to understand those forces. Not to predict the future, not to chase quick profits, but to make informed decisions based on probability, history, and the reality of the financial system we're living in. Let's begin with what has actually changed. Silver has reached price levels not seen in over a decade. It broke through technical resistance that has capped rallies for years. Trading volumes have surged. Institutional interest has measurably increased. This is not speculation. This is observable market behavior. When an asset breaks out of a long-term range with conviction, it tells us something about underlying demand. It tells us that the balance between buyers and sellers has fundamentally shifted. It tells us that participants who were once waiting on the sidelines have made a decision. The question is, why now? To understand that, we need to step back and look at the conditions that make silver attractive in the first place. Because silver doesn't move in isolation. It moves in response to forces much larger than itself. It moves in response to monetary policy. It moves in response to inflation. It moves in response to debt. It moves in response to currency debasement and loss of confidence in traditional financial assets. And right now, all of those forces are converging. Let's talk about debt. Global debt has expanded to levels that would have been unimaginable 2 decades ago. Government debt, corporate debt, consumer debt, all at historic highs relative to GDP. This isn't a moral judgment, it's a mathematical reality. Debt grows faster than the productive economy. And when that happens, there are only a few ways out. You can grow your way out, but that requires real economic expansion at a pace we haven't seen in years. You can cut spending dramatically, but that's politically and socially difficult. Or you can devalue the currency, make the debt easier to service by making each unit of currency worth less. History shows us which path gets chosen. It's not the painful one. It's the one that spreads the cost invisibly across the entire population through inflation. And inflation is why people turn to hard assets. When people lose confidence in the purchasing power of their currency, they look for stores of value that can't be printed, can't be issued by decree, can't be devalued by committee decision. Gold has always played that role. Silver, historically, has played it too, though often with more volatility and less institutional recognition. But silver has unique characteristics. It's both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, batteries. Demand is structural, not just speculative. And supply? Supply has been constrained. Years of underinvestment in mining, delays in new projects, rising extraction costs. These are not short-term issues. So you have rising industrial demand meeting constrained supply, all within an environment where investors are actively seeking alternatives to fiat currency. This is the setup. This is why the breakout is not random. Here's what typically happens when an asset begins a major move. Early on, very few people notice. The price starts to climb, but slowly. Media coverage is minimal. Retail investors aren't paying attention. The smart money, those who study cycles, those who understand value, they accumulate quietly. Then the asset breaks a key level. Suddenly, more people notice. Articles get written, social media lights up. Retail investors start asking questions. Some buy in, others dismiss it as a bubble forming. This is where we are now with silver. The mistake most people make is assuming that because something has already moved, it's too late. They think in straight lines. They think it went up, so now it must come down. But markets don't work that way. Major trends unfold over years, not weeks. They go through phases: accumulation, markup, distribution, decline. If we're in the early markup phase and the macro conditions suggest we are, then what looks expensive today may look cheap in hindsight. But here's the critical point. Nobody knows for certain. Anyone who tells you they know exactly where silver is headed is either lying or deluded. What we can do is assess probabilities. We can look at historical precedent. We can examine the conditions that have driven similar moves in the past, and we can manage risk accordingly. Let's go back to the 1970s. Inflation was running hot. Faith in the dollar was eroding. Gold and silver both entered historic bull markets. Silver went from under $2 an ounce to nearly $50 at its peak in 1980. That's a 25-fold increase in less than a decade. Was it a bubble? Eventually, yes. Did it crash afterwards? Absolutely. But that doesn't change the fact that anyone who understood the macro environment and positioned early made generational wealth. The key lesson isn't that silver always goes up. The key lesson is that during periods of monetary instability and inflation, hard assets perform. They don't move in straight lines. They're volatile. They test your conviction. But over the course of the cycle, they preserve purchasing power when paper assets fail. Then came the 2000s, another bull market in precious metals. Silver went from around $4 in 2001 to nearly $50 again in 2011. Again, driven by monetary expansion, driven by crisis, driven by central bank intervention and zero interest rate policy following the financial collapse. And again, it eventually corrected. Markets always do. But the investors who understood the cycle, who bought when others were fearful, who held through volatility, they succeeded. Now, let's look at today. We have central banks that expanded their balance sheets by trillions during the pandemic. We have interest rates that were held at zero for over a decade and are now struggling to normalize without breaking the economy. We have inflation that spiked higher than any time in 40 years. And we have a global financial system more interconnected, more leveraged, and more fragile than ever before. Does that sound like an environment where hard assets should be ignored? Here's where most people fail. Not because they lack information, not because they can't access markets. They fail because they can't control their emotions. When an asset is quiet and unloved, they ignore it. When it starts moving, they feel FOMO, fear of missing out. They buy at elevated levels, often near short-term tops. Then when it corrects, they panic and sell at a loss. This cycle repeats endlessly. It's the reason most retail investors underperform the market. Successful investing requires the opposite behavior. It requires buying when others are indifferent. It requires holding when others are panicking. It requires selling, when you choose to, into strength, not weakness. Right now, silver is attracting attention. That means emotions are rising. That means mistakes are about to be made. If you already hold silver, your challenge is not to get overconfident. Your challenge is to remember why you bought in the first place and to stay disciplined about your plan. If you don't hold silver, your challenge is not to chase blindly. Your challenge is to educate yourself, understand your risk tolerance, and make decisions based on conviction, not impulse. Let's address you first. Those who saw this coming, who positioned before the breakout, who endured years of sideways frustration. This is your moment of validation. But it's also your moment of greatest risk. Because now the temptation is to believe you've figured it all out. To assume the move will continue indefinitely. To get greedy. Don't. Markets are cyclical. What goes up will eventually correct. The question is not whether a pullback will happen. The question is when and how severe. Your job now is to manage this position intelligently. That might mean taking some profits to lock in gains. It might mean holding the majority for the larger trend. It might mean rebalancing to maintain proper portfolio allocation. What it should not mean is going all in, leveraging up, or assuming you found a one-way trade. Remember why you bought silver in the first place. If it was to protect against currency debasement, that thesis hasn't changed. If it was to diversify away from financial assets, that need hasn't disappeared. Stay disciplined, stay patient, and don't let short-term price action distract you from long-term strategy. Now, if you're watching this and you don't hold any silver, you're probably wondering, is it too late? The honest answer is, it depends on your time frame and your goals. If you're looking for a quick trade, if you're trying to catch a short-term pop, then yes, chasing here is dangerous. Breakouts often get tested. Pullbacks are healthy and expected. Buying at the peak of initial excitement rarely works. But if you're thinking in terms of years, not weeks, then the macro case for hard assets remains intact. The question you need to ask yourself is not, has silver moved too much? The question is, has the underlying reason to own hard assets changed? Is government debt shrinking? No. Is monetary policy tightening aggressively? Not sustainably. Is inflation gone? No, it's moderating, but the structural forces remain. So the case for owning some allocation to precious metals, as insurance, as diversification, as a hedge, that case is still valid. But here's the crucial part. If you decide to enter, do it intelligently. Don't put money in that you need next month. Don't buy because you feel like you're missing out. Don't invest money you haven't taken time to understand. Start small, educate yourself, understand what you own and why, and be prepared for volatility. Because silver is not a savings account. It's not a bond. It will swing. It will test you. And if you don't have conviction, you'll sell at the worst possible time. Let's zoom out even further. Because what's happening with silver is part of a much larger story. We are living through a crisis of confidence in the global financial system. Not a collapse, not a sudden implosion, but a slow, grinding erosion of trust in the institutions that have managed money for decades. People are starting to ask uncomfortable questions. Why does the money supply keep growing faster than the economy? Why do asset prices rise while wages stagnate? Why does it feel harder to get ahead even as markets hit record highs? These aren't radical questions. They're reasonable observations about an economy increasingly dependent on credit expansion and central bank intervention to function. And when people lose faith in the system, they don't announce it with protests. They announce it by moving their money. They move into real estate. They move into stocks of companies with pricing power. They move into commodities. They move into gold and silver. This is what we're witnessing. A quiet reallocation of capital away from pure financial assets and into things that have intrinsic value. Silver is just one beneficiary of that shift. But it's an important one because it's accessible, it's affordable compared to gold, it has industrial utility, and it has a history as money. That combination makes it appealing to a broad range of investors, from institutions hedging currency risk to individuals trying to protect their savings. One of the most difficult aspects of investing is timing. And it's difficult because it's largely unknowable. You can identify great assets, you can understand macro trends, you can recognize value. But knowing exactly when the market will recognize that value, that's luck, not skill. The investors who succeed over time are those who stop trying to time perfectly. They focus instead on time in the market. They buy quality assets when they're undervalued or reasonably priced. They hold through volatility. They add on weakness when the thesis remains intact. They don't panic during corrections because they understand that corrections are normal. This approach doesn't make for exciting content. It doesn't generate viral posts, but it works. And it works because it's rooted in reality, not fantasy. The fantasy is that you'll buy at the exact bottom and sell at the exact top. The reality is that nobody does that consistently. The goal is not perfection. The goal is participation in the long-term trend while managing downside risk. Let's talk about risk. Because if you're only hearing the bullish case, you're not getting the full picture. What could derail the silver thesis? A genuine, sustained economic boom that restores confidence in fiat currencies. A dramatic reduction in government debt and spending. A technological breakthrough that reduces industrial demand for silver. A major new supply discovery that floods the market. Are any of those likely in the near term? Probably not. But they're possible. And possibility is what risk management is about. There's also the risk of short-term volatility. Silver is a relatively small market. It can be manipulated. It can be whipsawed by large traders. It can spike and crash within days. If you're over-leveraged, if you're using borrowed money, if you're trading on margin, volatility will destroy you, even if the long-term trend is in your favor. This is why position sizing matters. This is why having a plan matters. This is why emotional discipline matters. The market doesn't care about your financial situation. It doesn't care if you need the money. It will do what it does, and you have to be prepared to endure that. Let's be very clear about the behaviors that destroy wealth during moments like this. First, don't invest money you can't afford to lose. This should be obvious, but it bears repeating. If losing this money would materially harm your life, you shouldn't be in the position. Second, don't use leverage. Borrowed money amplifies gains, yes, but it also amplifies losses. And in volatile markets, it can wipe you out before the trend has a chance to play out. Third, don't follow online hype blindly. Social media is full of people shouting about silver to the moon, posting rocket emojis, making price predictions with zero analytical basis. That's noise. Ignore it. Fourth, don't chase parabolic moves. If silver suddenly shoots up 10% in a day, that's not your signal to buy. That's your signal to be cautious. Parabolic moves end badly, always. Fifth, don't trade emotionally. If you check the price every hour, if you feel anxiety when it dips, if you feel euphoria when it spikes, you're too emotionally invested. Step back, reassess, get your emotions under control. Sixth, don't ignore diversification. Silver should be part of a broader strategy. It should not be your entire portfolio. No single asset should be. Seventh, don't assume this time is different. Every generation thinks they're living through unprecedented times. And in some ways, they are. But human nature doesn't change. Market cycles don't change. Gravity still applies. The investors who survive and thrive are those who respect risk, manage position size, and avoid the mistakes that have destroyed wealth for centuries. So where does silver fit in a thoughtful investment strategy? For most people, precious metals should represent a minority of their portfolio. 5 to 15% is a common range, depending on risk tolerance and conviction. The purpose of that allocation is not to make you rich overnight. The purpose is insurance, diversification, protection against scenarios where traditional financial assets underperform. Silver, specifically, offers unique characteristics within that allocation. It's more volatile than gold, which means higher risk, but also higher potential return. It has industrial demand, which provides fundamental support beyond just monetary demand. But it's also less liquid than gold. It's more prone to manipulation. It requires more storage space if you're holding physical. These are trade-offs you need to understand. If you choose to hold silver, you need to decide how. Physical coins and bars offer true ownership but require secure storage. ETFs offer convenience but introduce counterparty risk. Mining stocks offer leverage to the metal but introduce company-specific risk. Each approach has pros and cons. The right choice depends on your situation, your goals, and your risk tolerance. What's most important is that you make that choice consciously, not impulsively. Let's distinguish between two fundamentally different approaches to silver right now. Speculation is trying to profit from short-term price movements. It's buying because you think it'll be higher next week or next month. It's trading on momentum, on charts, on sentiment. There's nothing inherently wrong with speculation if you know that's what you're doing. But it requires different skills. It requires constant attention. It requires the ability to cut losses quickly. And statistically, most speculators lose money. Investment is buying because you believe the long-term fundamentals support higher prices over years, not days. It's holding through volatility because your thesis hasn't changed. It's being willing to be wrong in the short term to be right in the long term. Investment is harder emotionally because it requires patience. But it's more forgiving. You don't have to be precise, you don't have to time every move, you just have to be broadly correct about direction over time. Most people would be better served by the investment approach, but most people behave like speculators because it feels more exciting. Understand which game you're playing, and be honest with yourself about which game you're equipped to win. So where do we go from here? The truth is, nobody knows. Anyone who claims certainty is selling you something. What we can say is this: the conditions that drove silver higher are still in place. Debt is still growing. Monetary policy is still accommodative by historical standards. Inflation is still a concern. Industrial demand for silver is still rising. Those are facts. What they mean for price in the next month or year, that's interpretation. Silver could continue higher from here. It could consolidate in a range. It could pull back sharply before resuming the trend. All of those outcomes are possible. And your job as an investor is not to predict which one will happen. Your job is to position yourself so that you can handle any of them. That means having a plan. Knowing at what price you'd add more. Knowing at what price you'd take profits. Knowing what would invalidate your thesis. It means staying informed without being obsessed. Reading quality analysis without drowning in noise. Understanding the difference between signal and distraction. It means being humble enough to admit when you're wrong and disciplined enough to act on that admission. One of the most valuable things you can do during a moment like this is learn, not just about silver, about economics, about monetary history, about market cycles, about human psychology. Because the principles that govern this move in silver are the same principles that have governed markets for centuries. Understanding those principles makes you a better investor across all asset classes. It gives you a framework for making decisions under uncertainty. It helps you recognize patterns and avoid traps. Read books by investors who've survived multiple cycles. Study the history of money. Understand how central banks operate. Learn how inflation actually works, not just the simplistic narratives. This knowledge compounds. Each hour you invest in education pays dividends for decades, and it protects you from charlatans. Because when you understand the fundamentals, you can spot the frauds, the hype artists, the people trying to sell you certainty in an uncertain world. Education is the ultimate edge in investing. Not tips, not secrets, not insider information. Deep understanding of how the world actually works. And let's talk about the psychological challenge of holding through a major move. When silver was quiet, it was easy to hold. Nothing was happening. There was no pressure. And now that it's moving, every day brings new emotions. Greed when it rises, fear when it dips, doubt when it consolidates, euphoria when it breaks higher. This emotional volatility is more dangerous than price volatility, because emotional volatility leads to bad decisions. The way to combat it is through process, through discipline, through focus on things you can control. You can control your position size. You can control your entry and exit criteria. You can control how much time you spend obsessing over price. You can control whether you react to noise or stick to your plan. You cannot control what the market does tomorrow. You cannot control what other investors do. You cannot control headline events or policy decisions. Focusing on what you can't control is a recipe for anxiety and poor performance. Focusing on what you can control is a recipe for long-term success. This is true in investing. It's true in life. The investors who thrive are those who master their own psychology, not the market. If you're watching this and feeling like you've missed the opportunity, let me offer some perspective. First, you probably haven't missed it. Major trends take years to unfold. If this is the beginning of a structural bull market in hard assets, there will be multiple opportunities to enter on pullbacks. Second, missing one opportunity is not the end of your investing journey. There will always be another. The key is to be prepared when it arrives. Third, sometimes the best decision is to do nothing. If you don't understand silver, if you're not comfortable with the volatility, if it doesn't fit your strategy, then don't buy it. There's no shame in that. The only shame is in making decisions based on emotion rather than analysis, in buying because everyone else is, in abandoning your principles because you feel left behind. Successful investing is not about catching every move. It's about making good decisions consistently over decades. If you missed this one, learn from it. Understand what you could have seen earlier. Build the knowledge so you recognize the next one. And remember, the goal is not to maximize every opportunity. The goal is to build wealth steadily over time while avoiding catastrophic mistakes. We've covered a lot in this video: the breakout in silver, the macro forces behind it, the historical context, the psychology of investors, the risks, the opportunities. If there's one message to take away, it's this: understand what you own and why you own it. Silver is not magic. It's not a guaranteed path to wealth. It's an asset with specific characteristics that make it attractive under specific conditions. Those conditions appear to be present today, but conditions change, markets evolve. What works in one environment may fail in another. Your job is to stay informed, stay disciplined, and stay flexible. Don't get emotionally attached to any asset. Don't fall in love with your positions. Don't let your ego prevent you from admitting mistakes. Invest based on probability, not certainty. Manage risk before chasing reward. Think in years and decades, not days and weeks. And above all, remember that wealth is built through patience and consistency, not through home runs and speculation. The investors who succeed are not the ones who make brilliant calls. They're the ones who avoid catastrophic errors, who compound steadily, who protect capital during storms and deploy it during opportunities. That's the path. It's not glamorous, it's not exciting, but it works. Silver's breakout is significant. It tells us something about where we are in the economic cycle. It validates concerns that many have held for years. But it's just one data point, one signal among many. Stay curious, stay humble, stay disciplined, and whatever you decide to do with this information, make sure it's a decision, not a reaction. Thank you for watching. Stay informed, stay patient. And remember, understanding cycles and preparation matter more than reacting to noise.